Welcome to a new episode. Today we're discussing a significant component of the financial world, the influence of global events on the stock market. The world is a vast, interconnected web. Events on one side of the globe, whether they be political, environmental, or economic, can send ripples across the entire financial ecosystem. It's like tossing a pebble into a pond. The splash may seem localized, but the ripples extend far and wide. Similarly, the stock market doesn't exist in a vacuum. It's a part of a global financial ecosystem sensitive not just to local events but to happenings around the world. An election on one continent, a natural disaster on another, or a breakthrough innovation somewhere else, each can cause the market to surge or slump. With the world more interconnected than ever, it's crucial to understand the ripple effects that can occur. Global events often sway the stock market through their impact on economic indicators. Major events, be it geopolitical tensions, trade agreements, or natural disasters, can significantly influence economic performance. For instance, geopolitical tensions can lead to uncertainty, affecting investor confidence and causing market volatility. Trade agreements, on the other hand, can stimulate economic growth by fostering new business partnerships and opportunities. Natural disasters can disrupt supply chains, impacting industries and subsequently the stock market. Each of these events can lead to changes in key economic indicators such as GDP, unemployment rates, and inflation. As economies thrive or face challenges, stock markets react accordingly. For example, a strong economy with low unemployment and high consumer spending often correlates with bullish stock markets. Conversely, an economy in recession may lead to bearish market trends. As we can see, the state of the economy plays a major role in stock market performance. Currency fluctuations are another vital factor to consider. Now let's imagine a global event that shakes up the exchange rates. This could be a geopolitical conflict, a major policy change, or even a surprise election result. These events can cause currencies to swing wildly, impacting international trade. When a country's currency strengthens, its exports become more expensive and imports cheaper. This can squeeze the profits of companies that rely heavily on exporting goods. Conversely, when a currency weakens, exports become cheaper and imports more expensive. This can boost profits for exporters but hit importers hard. Moreover, multinational companies often operate in various currencies. If the exchange rate shifts unfavorably, the profits they make overseas might be worth less when converted back into their home currency. This can lead to lower earnings and, subsequently, a drop in stock prices. So, keeping an eye on currency fluctuations is important for investors in multinational companies. Now let's examine some real-world examples to better understand these concepts. Firstly, consider the global financial crisis of 2008. This economic downturn, triggered by the US housing bubble burst, led to significant stock market declines worldwide. Financial institutions crumbled, and investors faced substantial losses, illustrating how an event in one country can ripple across the globe. Next, let's look at political developments. Brexit, Britain's decision to leave the European Union, sent shockwaves through the global markets. Uncertainty about the future of trade and economic relations led to volatility in both the British pound and the stock market. Investors worldwide had to grapple with the potential implications of this unprecedented political move. Lastly, let's focus on public health emergencies, specifically the COVID-19 pandemic. As countries went into lockdown, businesses shuttered, and economies came to a standstill. Stock markets plunged as the future looked uncertain. However, as governments introduced stimulus packages and companies adapted to new ways of working, markets began to recover. The pandemic highlighted the resilience of markets and the potential for recovery, even in the face of global adversity. These case studies are not isolated incidents. They are part of a broader pattern of how global events can shape the stock market. Each event, whether it's an economic downturn, a political shift, or a health crisis, can create ripples that affect stock markets worldwide. But remember, while these events can cause short-term fluctuations, they do not define the long-term performance of markets. Investors who understand this dynamic can navigate these situations more effectively, seeing beyond immediate disruptions to identify potential opportunities. These case studies illustrate how global events can shape the stock market, providing valuable insights for investors. As investors, understanding these influences is only half the battle. We also need to navigate these global uncertainties wisely. This is where strategy comes into play. Firstly, diversification is an essential tool in the investor's kit. By spreading investments across a variety of sectors and geographies, you can mitigate the risk of being overly affected by a single event. Imagine it as not putting all your eggs in one basket. If one sector or country faces an economic downturn, your other investments may still hold strong, balancing out your portfolio. Secondly, staying informed is a crucial aspect of investment strategy. Knowledge is power, and in the world of investing, it's a currency of its own. Keeping abreast of global events, economic indicators, and market trends can help you make informed decisions. It's about understanding the ripple effect, how a political upheaval halfway across the world might impact your tech stocks, or how a trade agreement could boost your investments in manufacturing. Lastly, having a long-term perspective is vital. The stock market is akin to a roller coaster ride. There will be highs, there will be lows. But historically, it's shown a general upward trend. While it's important to monitor the market's pulse, it's equally important not to panic with every dip. By keeping a long-term perspective, you can ride out temporary downturns and capitalize on the market's overall growth. By employing these strategies, you can better weather the storms of global events and potentially turn challenges into investment opportunities.